Hello and welcome back to Introductory Financial Statements Modeling course. And before we move on to the lesson, and if you like our course so far, I strongly recommend you take a look at our course page www.financialmodelonline.com. Then click on the check out our online courses and choose Project Finance Modeling. You will be taken to the Project Finance Modeling course, and I recommend you take this course, which will give you a realistic project finance modeling training. After taking this course, you will be able to build real project finance models that assesses the risk and reward of lending to and investing in an infrastructure project. You should buy this course if you need to build a real-life project finance models. This course is offered at affordable prices. A similar course which provides realistic project finance modeling will cost you anywhere from $1,000 to $2,500 per course. Right now, we are running a limited time promotion, and you can get this course with a 50% discount using the coupon code half price. Please check out the curriculum of the course, and as you can see, we will start from the scratch and model the construction of the project and then the financing of the construction. We will model the revenue, the operating costs, the working capital, the capex, and we will also be modeling the important project finance ratios such as debt service cover ratio and loan life and project life cover ratios. We'll work on the important project finance accounts such as debt service reserve account and major maintenance reserve account. And finally, we will perform the valuation and model optimization. So again, right now we are running a limited time promotion, and you can get this course with a 50% discount using the coupon code of half price. So in this lesson, we'll be working on the valuation. The general formula for valuation of an asset or a company is cash flows divided by the discount rate less the cash flows growth rate. And the cash flows growth rate must be less than the discount rate. So how would you get to the cash flows? Well, you would repeat the steps we have taken in this course, such as modeling the revenue, the operating costs, capital expenditure, taxes, and etc. to get to the cash flows, and then you would discount them by the appropriate discount rate to get the net present value of your asset or a company. In this case study, we focus on the cash flows available to the shareholders, or in other words, dividends. However, based on the objectives of valuation analysis, valuation may be based on the unlevered free cash flows. These are cash flows available to both equity investors and debt holders. The valuation based on the unlevered free cash flows is typically applied to public companies. The discount rate in our formula represents the rate at which we discount our cash flows. In other words, how we bring those future cash flows to the present. The discount rate really represents the required rate of return and reflects the riskiness of the asset or company. As per our case study, the company that we work for has already established the required rate of return of 15% for this project. And finally, the growth rate of cash flows in our case is 0, and it is typical for infrastructure assets such as wastewater treatment plants or power plants not to have any growth rate. First, the plant is limited by its capacity. Second, it's limited by its off-taker, the buyer, who will be buying the output from the plant. We cannot produce more than the plant's capacity, number one, and number two, we only have one buyer, which is municipality, which is really a government. We sell 100% of our output, of our available output, to the municipality. So even if we wanted to increase our capacity, we won't be able to find the new buyers. We will apply net present value and internal rate of return methods to value our project. In a word of caution, the built-in NPV and IRR Excel functions are not suitable when performing the valuation analysis. And there are several reasons for that. First, NPV function is not transparent. It is more like a black box if you like. Valuation is important, so people who will use your model may want to see how you derived the values. Second, NPV and IRR functions are periodic. And what I mean by that is that if your model is based on semi-annual periods, then NPV and IRR will return semi-annual NPV and IRR. And it is industry best practice that NPV and IRR are annual. And finally, NPV and IRR functions do not take into account dates, such as valuation date or dates in your timeline, which is always important. So how do you resolve the valuation issue? The approach that we take in this course, and really the best modeling practice, is to model the discount factor first and then apply that discount factor to the cash flows, which will give you the net present value. We will shortly see how to implement this in our model. As for IRR, we will be using XIRR Excel function, which takes into account the dates. That's a lot of theory already. Let's jump into the model now and do some real work. Let's create the valuation sheet from our template sheet. And let's rename it Valuation or Val. And let's name the whole block as Shareholder Valuation. And the first item that we'll be modeling will be discount factor. In order to model the discount factor, we will need the valuation date, and according to the case study, it's December 31st. Let's mark this as placeholder. And next, we will need the days in the period. This is modeled based on the annual periods, so it's going to be 365. Days, and this is going to be date. Again, this is a placeholder. And next we will need the model end period dates, so let's get it from our timesheet. Let's mark this red. This will be exported. Copy. Let's go back and paste the link. F2, F4, copy across and paste. Let's copy the whole row here and paste the formatting. So let's mark this blue. This is important link. And now we're ready to model the years from valuation date. And the formula is going to be the financial period end date less the valuation date divided by the days in a period. Anchor it, and then copy across and paste. Next, we will need the shareholder required rate of return, which is 15% according to the case study. And we will mark this as placeholder. And let's get these years from valuation date, copy and paste the link. F2, F4, copy across and paste. So we are now ready to model the discount factor. And the formula for discount factor is going to be 1 divided by 1 plus the shareholder required rate of return, anchor it, and to the power of the years from valuation date. Copy across and paste. Next, let's select the whole row and then F11 to chart the discount factor. And as you can see, the discount factor decreases sharply from approximately 1 in the first period to approximately 0.2 in the last period. And this is expected, so we modeled it correctly. We are now ready to model the cash flows, which will consist of cash inflows and outflows. And the cash inflows consist of shareholder capital redemption and the dividends. So let's get the share capital redemption from financial statements. Select the whole row and copy. Go back again, select the whole row and paste. Now do the same for dividends. Let's model the cash inflows now. Take the sum. And the cash inflows will be the sum of share capital redemption and dividends. Copy across and paste. Next, we will model the asset purchase price. And if you remember, the asset purchase price needs to be such that it generates the 15% IRR, which is written in the case study instructions. The model shall indicate rough estimate of the maximum acquisition price of the asset that generates IRR of 15%. I just highlighted it for you. For now, let's make an assumption of 15 million. Let's mark this as a placeholder. Next, we'll need the acquisition flag, so let's get it from our equity sheet. And now we're ready to model the cash outflows. So the formula is going to be the asset purchase price anchored multiplied by the acquisition flag. Copy across and paste. Now we model the total cash flows, so cash inflow, copy and paste the link. F2, F4. The cash outflows, copy and paste the link. F2, F4. Copy across and paste. And the total cash flows. The formula is going to be sum of cash inflows and outflows. And let's rename this total cash flows to shareholders. Now we're ready to model the present value of cash flows to shareholders. We will need our cash flows to shareholders, so copy and paste the link. F2, F4. Next, we will need the discount factor, so copy and paste the link. F2, F4. Copy across and paste. And we're ready to model the present value of shareholder cash flows. And the formula is going to be the cash flows to shareholders multiplied by the discount factor. Copy across and paste. So let's calculate the net present value of shareholder cash flows. And that's going to be the sum of present value of shareholder cash flows. So we've got our NPV, which is based on the shareholder required rate of return of 15%. And now we're ready to model the internal rate of return. We will need our cash flows to shareholders. So let's copy and paste the link. F2, F4. And we'll need the financial period end dates. Just copy the whole row. And select the whole row and paste. And we're going to be using XIRR function. So XIRR, first we're going to take the cash flows, and then we're going to take the dates. So we got the IRR of 46%, and that's based on the asset purchase price of 50 million, as you remember. And according to the case study, the IRR that we get shall be 15%, 1.5. So we have to optimize a little bit this model. Before we do that, let's clean up the model. Now, in order to bring this IRR down to 15%, we'll have to adjust the asset purchase price. Let's rename this to maximum asset purchase price according to the case study. And we're going to be making use of a goal seek in Excel. So let's access it. We want to set the IRR cell or the value in IRR cell to 15%. So 15% by changing the cell, which is maximum asset purchase price. Press OK. And again press OK. So let's format this. And we got our maximum asset purchase price, which is giving us a 15% IRR. And we completed the case study, the task in the case study, which was recommending the maximum asset purchase price that generates 15% IRR. This completes our short introductory financial statements modeling course, and the next step typically would be to run some sensitivity analysis or create a scenario manager and test the model for different scenarios. And then the final step would be to create an input sheet and reallocate all these placeholders that we have in our model, such as maximum asset purchase price or valuation dates, and we have number of placeholders in different sheets. So the final step would be to reallocate all these placeholders to input sheet. We will not be doing this in this course in order to save our time. The main task has been completed. We modeled the financial statements and we got the valuation number. Thank you for taking our course, and if you want to learn more, please refer to www.financialmodelonline.com and enroll in our Project Finance Modeling course. In Project Finance Modeling course, we will build a full and complex project finance model, which you see right now in front of you. It will be based on a toll road case study, and we will model the construction finance, and then the revenue, the operating costs, the working capital, the capital expenditures and fixed assets, the taxes, the equity, the debt, including the sculpted debt service profile, the important project finance ratios, the debt service reserve account, the major maintenance reserve account, revolving credit facility, the shareholder loan. We will carry out the valuation, model the financial statements. So as I mentioned earlier, right now we are running a promotion, and by using the coupon code of half price, you can get a 50% discount when you purchase our course. Again, thank you very much for your time, and hopefully I will see you soon.